right, now to our first conversation. We're unpacking the latest FOMC meeting. Global oil market was played out so far, and export commodities. Joining me now, Mr. Bismarck, Rewane, MD, CEO of Financial Derivatives Company. Great to have you on the show, sir. Good morning.
Good morning, and welcome to Rainy Lagos.
Yes, Rainy Lagos, post FOMC meeting, trading day, and yes, as it was expected, even though some, said that we might actually see a surprise from the FOMC yesterday, maybe a hike, but that didn't happen. They kept interest rates unchanged, but markets seem more uncertain at this point, sir. What were the key takeaways for you?
First of all, let us understand that the FOMC is made up of 12 members. 3 voted to increase and 9 voted to maintain status quo, which means that the sentiment is not for reducing rates, because some people and Donald Trump would like to see interest rates come down as it affects people's mortgages. So we are in a contractionary interest rate environment. 2, consequence of that is that the dollar strengthens. Right? And when the dollar strengthens, all other currencies actually weaken. And as the dollar strengthens, the price of gold actually declines. So what we have seen is that borrowing costs in the United States is at a 19-year high because of this. And the markets have already priced at it. Simultaneously, as this was happening, as you alluded initially, was the fact that there's military activity taking place in the Strait of Hormuz and in Iran. So on one hand, we're having the price of oil increase because of to about $92, $93 a barrel because of what's happening in the Strait of Hormuz. We talked about the insurance premium going as high as 8.5%. On the other hand, we have domestic contractionary effect to minimize the impact of inflation. So, Kevin Walsh said that the target of inflation is 2%. And now we are seeing there's a fear that inflation in the United States could go as high as almost 4% if care is not taken. That is significant. And remind you, in about 97 days from today, there will be the midterm elections. So this thing is not coming. There are no easy options, and choices are hard to make. So definitely, we see that now. The question is, how does it affect us in Nigeria? First and foremost, because interest rates have increased and because yields in those markets have increased, definitely, the amount of foreign portfolio investments that are coming to Nigeria will reduce. They'll be asking for more. Therefore, it is almost clear from all indications, except something drastic happens, that the Nigerian Central Bank, in its meeting in September, will have to probably maintain a hold again, because our policy rate is NPR is 26.5% per annum. Inflation is at about just maybe slightly near 16%. So there's enough headroom there. But the impact of this is that the cost of borrowing by the federal government of Nigeria in particular increases, and that is not good news for the intention to stimulate the economy into 1, higher growth, 2, to reduce the impact and cost of borrowing for domestic borrowers. For example, and I tell you this, our debt service as a percentage of GDP is now 4%. Typically, anything above 3% calls for concern. Our domestic debt service in 2025 was 8.6 trillion naira, while our external debt service is $5.15 billion. So this is a very it's a tricky fiscal and monetary environment for Nigeria, especially we are only 6 months away from an election.
Right. So definitely looking at some sound bites coming from President Trump. I believe the first time he did say that Kevin Walsh knows what to do, but the only problem is he has to seek the approval of a board. That's talking about the FOMC. But President Trump did blame Jerome Powell, before now, saying he was moving too slow, he's not cutting rates on time. But it seems President Trump understands now why Kevin Walsh can't cut rates.
But I think we have to understand something, Ladi. the Supreme Court has said that of all the agencies, the president has powers to do anything, but they exempted the Federal Reserve. You cannot remove anybody except for cause, and it has to be proven beyond reasonable doubt. Two, John Powell is still a member of the Federal Open Market Committee. He's not stepping down. Typically, former Fed chair step aside and go away, but he's still there till the year 2028 or something like that. He's there for another 2 to 3 years. So you can't wish him away. So I think clearly the independence and autonomy of the Federal Reserve Bank is very, very critical to the stability, macroeconomic stability of the United States. And there's evidence, clearly, Larry Summers and others have written and documented it, that if you do not, the more autonomous and independent the central bank, the more sustainable economic growth and economic performance in that country. And you can see it playing out in Nigeria. The Nigerian Central Bank of Nigeria has proven clearly that they are independent, they are autonomous, and they're not going to be anybody's poodle or lapdog. So, and you can see that the performance of the economy in certain respects, as monetary policy and inflation is concerned, and the value of the currency is doing pretty well, fairly well. So I think that all of these points to the fact that countries where there are independent and autonomous central banks, and there's no minimum intervention or meddling in the affairs of the central bank, those economies do well. And both here, the Bank of England in the United Kingdom, the European Central Bank, and the Federal Reserve have all shown us that this is important.
All right, so definitely, Fed Chair Kevin Walsh deliberately avoided giving, strong forward guidance. As expected, he did say we shouldn't expect the Fed to be speaking so much. Has the Fed become less predictable at this point, and does that mean uncertainty, and does that mean risk, for global financial markets with all of that uncertainty?
No, that is not it. The thing is that forward guidance leads to, we're in a period of predictive analytics. Forward guidance kind of tells you what the feeling is, but removing it doesn't want it to be like a lottery. Removing the predictive analytics, and every economist who is worth a salt can tell you that based on inflation, the CPI, the PCE, and other measures, it's clear that what the Federal Reserve will do, rather than just having a probability and a Russian roulette where we are predicting what will happen, and people make markets out of that. Don't forget that in the previous system, in the last 1.5 years, the markets have become more like a speculator's paradise. But you can see what's happening to AI and what had happened to the Magnificent Seven, all the stocks yesterday, while they were reading about how much spent on AI, and then all of them reported super earnings, but their stocks came down. And interestingly, today we saw that Samsung reported blockbuster earnings, and yet the market has not taken it. We expect when the markets open, Samsung stocks will do well. So basically, I'm trying to predict where the markets go when there are so many uncertain variables. One, the war in Iran, the emotional mood swings of the United States, the Federal Reserve, inflation, and I point out one thing more. The price of petrol, PMS, the United States is now above about $4.11 per gallon, which is over $1 per liter. In this case, the cost of transportation in the United States, the cost of your mortgage, right, and the price of commodities people are now, in fact, in the United States, the affordability crisis points to the fact that people are borrowing to buy groceries, right? So it's not just here; everywhere, the consumers are struggling. So we have some interesting days ahead. I think especially also domestically as well.
Right, with the emotional swings, mood swings of the U.S., as you put it. Okay, so you did mention higher. That means higher borrowing costs if interest rates stay elevated. in the U.S. So what should a government like Nigeria be doing right now to hedge, against this?
One is that Nigeria is not isolated, right? And Nigeria is fairly insulated because of its reserves. But the external reserves, what you need to do is to maintain a tight monetary policy and ensure that you, like the IMF said, what we call fiscal neutrality. In other words, control your spending, block the leakages, and ensure that money that shifts from people to government is efficiently recycled. I think that's very, very important to note. But also, the thing is that we are months away from an election, so it's difficult to have a restrictive fiscal spending stance, right? And because that is not compatible with the electoral endeavor. So, the Nigerian policymakers are caught within the political expediency and the economic necessity. So when you have to trade off, you can't make omelets without breaking eggs. Therefore, policymakers have to walk a very thin line, right, to ensure that one does not override the other in terms of political expediency on one hand, macroeconomic necessity on the other. So when you have a middle path, you're able to get through. But for us, the stock market lost a little bit yesterday, and so the market is in anticipation of the Dangote IPO, which is going to be a big one. The market is in anticipation of earnings that are going to come out, and more than anything else, the GDP for Q2, which a lot of people are calling predictive analytics, is saying that we will have about 3.8 to 2% growth. If the growth comes in strong, inflation stays moderate, then you might be trending softly towards some kind of soft landing. But macroeconomic indicators, without becoming welfare, where people can feel some kind of prosperity, and the government likes to call it shared prosperity. In fact, the two words are shared prosperity. You can have prosperity which is not shared, right? And you can have prosperity which is shared. The policymakers now should ensure that prosperity is shared, and giving you two major variables: one, power supply, and two, insecurity. Security leads to political insecurity. Political insecurity leads to outcomes that are not desirable.
All right, Mr. Rewane, definitely we're looking for shared prosperity at this point. I'm talking about the markets here in Nigeria. We see the earnings are rolling in at this point. We'll definitely keep tracking them. Thank you so much, Mr. Bismarck Rewane, MD CEO, Financial Derivatives Company. Thank you, sir.
Thank you for having me.
All right, we'll take a moment now. When we come back, we'll talk artificial intelligence and financial services. What to expect. That's next. So stay with us.